Would you rather tie up $5,000 just to make a 1% return in a month, or use $200 to control the same stock and possibly make 50% in that same time? That's the power of option trading: leverage, flexibility, and opportunity. But here's the problem: options can be confusing. And if you mess it up, you can lose a lot more than just your time. That's why in this short video, I'm breaking down the basics of options in a way that actually makes sense, with simple analogies, visuals, and real examples. What are options? An option is a financial contract. It gives you the right, not the obligation, to buy or sell a stock at a set price by a certain date. Each contract represents 100 shares. Always remember that one option equals 100 shares. And unlike buying stock outright, you're putting down a much smaller amount of money, called a premium, to control that larger position. That's called leverage. Now, imagine this. Let's say you want to go to a major sport event, an NBA Finals game, for example. Tickets today are priced at $200 each, but you can reserve your seat now with just $20. If demand goes up and the ticket price hits $300, you're locked in at $200. If you want, you could resell it at the higher price. Great deal. But if prices drop to 150, you're not obligated to buy. You just lose the $20 deposit. That's exactly how a call option works. Your loss is limited to the premium, but your upside potentially huge. Betting on the upside. A call option gives you the right to buy a stock at a specific price, the strike price, before expiration. If the stock goes above the strike price plus your premium, you're in profit territory, known as being in the money. If the stock stays below that break even, you might end up out of the money and lose just your premium. But compared to owning 100 shares outright, you've risked far less for a potentially huge percentage return. Betting on the downside. What if you think the stock's going down? That's where put options come in. A put gives you the right to sell a stock at a set strike price. Say a stock is at $100 and you buy $90 put. If the stock drops to 85, you can sell it at 90. Boom, profit. If the stock doesn't fall, you don't have to exercise the option. You just lose the premium. That's the beauty of it. Defined risk, but asymmetric reward if you're right. Important lingo: strike price, target price in the contract, premium, cost of the option. In the money, you're in profit zone. Out of the money, somehow no value if exercised. At the money, well, in the stock price equals strike price. A call option example. Let's say a stock is at $100. You buy a 105 call option for $1 premium per share, or $100 total. If the stock hits 107 before the expiry, your option's premium, now worth $200, you can sell it for a 100% return. If it ends up at 104 or less, you lose your premium. That's the worst case scenario. Quick example: a put option. You buy $90 put option on a stock that's currently priced at 100. The premium, 75 cents or $75 total. If the stock drops to 85, your profit is $500 minus your premium is equal to $425. Massive return on a small bet, if you're right. What about selling options? Now, yes, some traders sell options instead of buying them. You might hear about selling naked puts or calls, meaning no protection and full exposure. That might sound exciting, but it's very risky and often not smart unless you're fully capitalized and know what you're doing. A better approach: use offsetting positions, like vertical spreads, to lock in the difference, cap your risk, and reduce the margin required. This way, you're controlling your exposure instead of gambling on unlimited moves. Flexibility equal power. This has been a very brief explanation of what you can do with options, but the real power comes when you start combining calls, puts, and expiration timing. You gain real leverage, customized risk, and the ability to profit from a wide range of scenarios, not just hoping a stock goes up or down. That's the edge options give you: control, creativity, and adaptability. Want more? Leave a comment or DM me for a one-on-one breakdown, or explore the detail of a full course. Subscribe for smarter trading insights.